George Soros once said something that sounds completely backwards. I'm only rich because I know when I'm wrong. Most investors spend years trying to prove they're right. Soros built one of the greatest fortunes in history by doing the exact opposite. So, why did one of the world's most successful investors change his mind so often? And could that habit be the real secret behind his billions? To understand that, you have to forget the image of the fearless billionaire who always knows what's coming next. George Soros didn't believe he could predict the future with certainty. In fact, he believed certainty was one of the most dangerous traps an investor could fall into. Born in Hungary and surviving Nazi occupation before eventually building a legendary hedge fund, Soros learned early that the world is unpredictable. Markets, like people, don't behave according to perfect logic. They're driven by emotions, expectations, fear, greed, and countless unknowns. That realization became the foundation of everything he did. Most investors treat the market like a mirror that reflects reality. Soros believed the market actually shapes reality. He called this idea reflexivity. Imagine a company whose stock price starts rising. Investors see the rising price and assume the company must be doing well, so they buy even more shares. That rising stock price makes it easier for the company to raise money, expand, and actually improve its business. In other words, beliefs influence reality, and reality reinforces those beliefs. It's a powerful feedback loop. But here's the fascinating part. If people's beliefs can push prices away from reality, then those beliefs can also reverse suddenly. That's why Soros never became emotionally attached to his opinions. He treated every investment like a working hypothesis, not a personal identity. One of the most famous examples came in 1992. Soros believed the British pound was overvalued and couldn't remain fixed within the European exchange rate mechanism. After studying economic conditions, he made an enormous bet against the pound. When the British government was forced to devalue the currency, Soros reportedly earned around $1 billion in a single day. Most people remember the profit. Far fewer remember that throughout his career, Soros frequently adjusted or even abandoned positions the moment new evidence appeared. His success wasn't about always being right, it was about refusing to stay wrong. This is where most investors struggle. We naturally defend our opinions because changing our minds feels like admitting defeat. Psychologists call this confirmation bias. We search for information that supports what we already believe and ignore evidence that challenges us. Soros trained himself to do the opposite. If the facts changed, he changed quickly. Ray Dalio, another legendary investor, echoes a remarkably similar principle: embrace reality and learn from mistakes rather than protecting your ego. Different philosophies, same lesson. The market doesn't reward pride, it rewards adaptability. So, what can we learn from George Soros? First, separate your identity from your investments. Owning a stock doesn't make it part of who you are. Second, treat every decision as temporary. New information deserves a new conclusion. Third, staying flexible is often more valuable than making bold predictions. And finally, remember that the goal isn't to be right more often than everyone else. The goal is to lose small when you're wrong and let your biggest insights compound when you're right. George Soros didn't build his fortune because he had a crystal ball. He built it because he understood something most people never do. The strongest minds aren't the ones that never change, they're the ones that know exactly when to.